good afternoon. I think first I should start with some disclaimer, to be very honest. So since I had some time on my hand, this is not my most well-prepared session. But having said that, the topic of AI and bias is very close to my heart, which is one of the reasons I even agreed to spend 15 more minutes here before I run. That being said, I did have a chat with Nagesh before the session here on Digitap. So I think the key, so let me see, I don't want to start with bias, Nagesh, so let's start with some more positive things in life. You know, fintechs like you pretty much operate at the cutting edge, right? So, I mean, with due respect to bankers here, if banks could do it well, then you won't be in existence. But it's clearly they're not doing it well. That's why you are where you are. I think the key is, how do you ensure, say, explainability and compliance, especially when dealing with, say, sensitive segments, like, you know, new to borrowing or underserved borrowers, which is where you operate. How do you deal with that?
Hello. Sorry, I thought my mic was not working.
No, it's on.
All right, thanks. So typically what as fintech providers, or we call ourselves as infra providers, right? So what we do is we work on a lot of models by looking at alternate data, right? Okay. And when we say alternate data, it is basically the data that is alternate to a bureau score or a credit model, right? So let's look at a traditional way of dealing with credit underwriting, for example, right? Say about 10 years back, I mean, if you had to take a loan, you would always go and say that I'll lend you if your CIBIL score is good, right? Or if your bureau score is fine. Now, that has ended up where banks or most of the large enterprises, even in large NBFCs, right, typically end up in a space where they only deal with customers who have a good bureau score, right? But in India, especially with the financial inclusion and everything that is happening, right, there has been a huge proliferation of customers in the segment where they never had a credit history put together, right? So these are the customers who are, for the first time, getting into the job market, trying to apply for a credit card, right? Or people who never had access to credit previously, working in tier 2, tier 3, tier 4 cities, or even like gig workers in the tier 1 and metro cities, right? Who never had access to credit, right? I mean, they never were welcomed by the so-called these banks. So now what happened is, with the proliferation of a lot of these fintechs, credit became accessible to them, right? But the most important thing that these fintechs were grappling also was, now how do I underwrite these customers, right? How do I know among these customers which customer is the right one for me to give a loan and which customer should I ignore, right? Now if you go by a credit model or a credit score, and these customers never had any credit score with them, right? So that is when, you know, players like us, we identified a gap there, and we said, okay, you know what, let's look at alternate ways of underwriting these customers, right? Now, what are these alternate ways? And whatever ways we identified in terms of underwriting, our primary goal was to say that, you know, how does this data point that we can derive for this particular customer help me in understanding whether he will default or not, right?
Understood.
So then what we did is we looked at 6 or 7 different data points of that particular customer, which is basically, it could be your bank statements, or it could be your device data, it could be data on the basis of your mobile number, his social media presence, is he employed, is he salaried, right? So we looked at these data points and started building models on top of those data points, which helped our clients to take a decision as to whether this guy is creditworthy or not, right? Now coming to the explainability of these models, right, which is very critical, and sometimes we also feel that that's one of the things why our sales cycles are also long, right? Because we can't go to a bank or an enterprise and say, hey, here you go, we have a model, plug it in, and then you can start disbursing on day one, right? That is when we have to undergo a lot of POCs with our banks, right? So there's huge amount of POCs that we do. We give a lot of time for the models to mature, right? So there are clients of ours who go live on day one, but then they say, hey, we need 6 months of our data for us to understand whether this model is making sense or whether we need to tweak the model, right? So that's the reason why there is a lot of POCs and see, basically these models are at best, they work when the more the data, the models work well, right? So it takes time for us to gather the data, build models, and then, so that's where it's very important, the explainability and the accuracies of the models, right? Because we are dealing with credit here, even a small 1% false data or a false model prediction will lead to a 1% increase in their NPAs, right? So that's a huge this thing. So, and as well as in terms of the compliance, right? I mean, the amount of data that we deal with, it's extremely important for us to be aware of what compliance we need to be having in place with the DPDP acts coming in. How do we deal with the privacy of the customer data and who owns the data? And if he is the owner, then what is the data purge that you will have to put in place? How do you deal with customers who don't want their data to be with you for longer duration? How do you give them access to deletion of the data, purging of the data? So all these compliance things have to be taken into consideration before we even take the data for our model preparation.
Yeah, so I actually have a follow-on to this, Nagesh, on that. So do you use any AI-based tools to clean the data that comes you from various sources? So because the biggest challenge that I have seen, especially in the BFSI industry, is the availability of good quality of data. How do you clean it, or do you use anything at all?
I mean, that's a very good question, right? If you look at the applicability of AI, especially in BFSI, I've seen the applicability in 3 areas, specifically related to data, right? One is, how do I apply AI to get the data in the first place? Or previously, I never had access to that data, but can I now use AI to get access to that data, right? The second area is, once I have the access to that data, how do I make it machine readable? Or exactly the point that you made as to how do I make it structured so that I can make some meaningful models out of that particular data, right? And the third portion is then actually making sense of that structured data as to how building models on top of it and then giving a decision or applying that data for a particular use case, right? So that's the third application of the AI models that we have. Nowadays, with a lot of these government initiatives, I'm seeing more and more of the AI application vanishing in the first 2 areas because you take account aggregator as an example, right? So account aggregator is now saying that, you know what, with the customer consent, you can now go and pull the data from the source, which could be your bank statement or it could be your mutual fund statement or anything of that sort, right? So now I don't even have to now deal with any of these AI models as to, whether the data is available, whether it is structured, whether it is unstructured and things like that, right? But having said that, the more focus going forward, especially in the BFSI sector, is moving towards how do I build better models on the structured data that is being made available. So that's where the focus is moving towards. But yes, we do have several AI models that we even today use for some of the data that is coming in an unstructured manner. But it is actually pointing to a very good use case in terms of lending.
Interesting. So my next question, Nageen, is more macro, okay? I would say pretty much at 50,000 feet. I think the key, so there's one question that keeps playing on my mind is, as a country, and specific to BFSI, because that's where at least I operate, is that can we afford to regulate AI after it's adopted, or do you get it in design phase? What I've been seeing is I think we are lagging, but again, I only have that much view, so it'll be useful to hear from you.
It's actually kind of a hot topic right now in terms of what should the regulator or even the government do with AI, right? And I will not get into this debate of whether the government should regulate big tech companies and all that. So that's a whole lot debate. That's for a separate day. But say if you ask players like us, right? We are a private limited companies who are doing quite a bit of AI and applying AI for use cases that are being used by a lot of regulated entities, right? And the moment you say that you are actually working in AI, you invariably deal with a lot of data, right? I mean, without data, there is no AI. Because you need data to train your models, you need data to then do reverse engineering in terms of how the models are effective and all that, right? It makes sense for regulation to come in for people or for companies, even private limited companies, who are actually dealing with data, and not just data, but who are actually dealing with a lot of PII information, right? Especially in the BFSI space, when you have to come up with models for underwriting and all, you invariably have to deal with a lot of PII information like your PAN numbers or mobile numbers and stuff like that. Now, in the traditional sense, this information was always with your regulated entities like banks and NBFCs and all, right? But with these new age fintechs and data infra providers like us coming in, we also need to have some amount of access to that particular information for us to be able to build better models and all that, right? So it is, right now we are doing like sort of a self-regulation on our part where we say that after we build the model, we will not we purge the data, we will not store the data and things like that. But it is always good that to have a body in the sense who can also have a regulation in place for companies like us. With that just builds confidence for our clients as well, right? Right now what our clients who are majorly regulated entities, who are either regulated by RBI or a SEBI, what they do is they are doing some amount of audits on us in terms of ensuring that everything is in place and we are not doing anything erratic with the data that they have provided us. But just having a third party or a regulator coming in place and providing that confidence to these clients of ours that, you know what, don't worry, we are there, we are regulating these guys. And that just helps everybody in the ecosystem.
Thanks, Nagesh. So I know I'm running, I'll slowly run out of time, but I want to touch upon my favorite topic, which is bias in AI. And so the question on bias is, see, bias in AI, to my mind, is not a tech issue. It's more like, at least to me, it's a systemic risk. So what I would want you to tell the audience here, few real-world examples of bias in AI that you have seen.
Well, we typically come up with a lot of bias. I mean, it's a very common thing that we almost deal with on a regular basis, and it is almost like ingrained in our conversations with our clients, right? So anytime we go and try to sell them an alternate data model, saying that this is what the output that you would get if you use this model, the first thing that they'll ask us is, what is your false positive, what is your false negative rates, right? And more importantly, in my opinion, especially when you're building models on this alternate data, right? More than the false positives and false negatives, what tends to happen is we build a model for a particular client, right? And we believe that to be a universal model, and we try to apply the same model to a different client, right? But then we realize that this particular model is not working for the second client, right? And that's predominantly because they both operate in a different customer segment altogether, right? So the model that you might have built for, say, a customer segment that is in a tier 2, tier 3, lower income customer segment will definitely not work for, say, a bank which is actually dealing with your premium customers, maybe, right? So that itself ensures that there is a lot of bias in that particular area, where we then have to go in, retrain the models, and then showcase our ability that you have the capability to right now custom build these models for different clients, right? But having said that, I mean, over a period of time, like how bureaus have evolved, because now bureau model is so universal that whether you go to a bank or whether you go to a microfinance company, the bureau score holds, for different customer segments, right? There's no bias over there. Like this works only for this customer, this doesn't work for this customer. I believe that with more and more data coming in, with more and more models that we build, we'll also have a universal model at some point in time, which will take all your alternate data in place and then build a model which is alternative to Bureau. Yeah.
Hey, thanks, Nagesh. I can see that we are slowly running out of time, but I do want to summarize my three key takeaways from this conversation, okay? Number one, I think, was data lineage. I don't know, but you didn't say lineage. I'm kind of summarizing it for you. But I think it's important in the context that we live in. Data lineage is key. It's far more easier said than done. I can tell you the largest of organizations struggle. We are working with huge projects on data lineage, especially for banks. Number two was on regulation. Yes, it should be there. That's to, how do I put it? To raise the level of confidence in the industry. Number three, to my mind, is biases for real. Very clearly, no matter how much and where you are. I don't want to get to the percentage of false positives, but yeah, it's like for the audience here, you know, if you're running an L3 type SOC, and I'm talking now probably 5-year, 10-year in the past, so the biggest yardstick was, what's the kind of false positives is your SOC generating? I'm just trying to draw a huge parallel between that to the AI world. So from where we were a decade ago to where we are now in a typical SOC DC world, that L3 false positives have reduced, right? I personally see the same trend. Yeah. Of course, this field is much better.
Yeah, I mean,
from a model standpoint.
For me, just on the bias part, you cannot eradicate bias, but it's just about how closer you will get to that 100% accuracy and without zero bias is where you want to be, right? And the company that is able to achieve that closer to 100% will have the edge over their competitors. That's where everybody is working towards. Yeah.
Thank you very much, Nagesh. I can see